All righty, welcome everybody. It is May 1st at 2 o'clock Eastern time, the different time zones across the United States. I am joined here by Greg Northrop from iTValuations and IT Tax Advisors, one of the managing partners and somebody that we had the pleasure of being on a webinar last Thursday for, and now he's joining the favor for us. Greg, how are you doing today?
I'm doing well, Casey. Thanks for having me on. And how about yourself? How are you doing?
Terrific, terrific. I'm sure you felt it in Minnesota, but the weather's been up and down the last 5, 6 days. It's gone from freezing to hot to freezing to thunderstorms to hot, and now it's warm again. So I'm happy about that. But today we're talking all about the valuations of MSPs. What's the current market? What's the landscape for transactions? What things are you looking for in terms of valuating, especially if you're looking at selling or any M&A activity for your MSPs? I think this is an area, I know this is an area where there's a lot of confusion. There's a lot of bad advice out there of what's important and what's not. I'm going to start just with a very simple question. What is the first thing? What is the main thing that you are seeing in terms of the landscape that just is a common theme? Every conversation, this is brought up around valuations for MSP owners.
Yeah, well, number one in the landscape today, there are more buyers than there are sellers right now. And so because of that, it's really, thinking about the law of supply and demand, from your basic economics course, right? When there's a greater degree of demand for companies and less supply, it generally pushes the prices up. Now, that being said, there's a certain kind of inflection point where prices won't go beyond a certain point based, and that point
Absolutely.
is capped at whatever the operational maturity level or kind of just the state of the operations, the financial profitability, et cetera, for that company, that sets the cap. So a lot of what we're doing with companies when we're advising them on their value is, yes, there are EBITDA multiples out there that you can go and look up and say, all right, I'm a 5x, 6x. I would caution against slapping a multiple on your EBITDA and assuming that's your
Yes.
value, right? Because there are more things that go into that. There's revenue, there's your overall financial rigor, like the state of your financial hygiene and your financial statements.
Yeah.
What is your recurring revenue? What are your margins? What are your billing practices? What is the vertical, if any, that you're maybe specialized in versus another? Where is your geographic region? Do you have an actual management team in place? And so we look at all these factors, and what we're seeing is companies that have a lot of those things in place where they're truly operational mature. They have a management team. They have a really high recurring revenue from like managed services. You start putting all those pieces together. Now, all of a sudden, not only are you a very highly operationally mature company, you're like basically the prettiest company on the marketplace because there's really very few of those companies going to market. And so you can actually command anywhere from a half turn to a full turn higher multiple when you go to transact.
Yeah, yeah, I hear a lot. We hear it all the time about EBITDA, and some people would say EBITDA schmebida, like it really doesn't matter from most buyers' perspective. More often than not, they're looking from a gap financials. But then, as you said, they're looking at the scrutiny of, do you have a good business in place? Do you have the records? Do you have the contracts? And do you have the valuable assets? Because there's always two different forms. You can asset sale or stock sale. And I think being able to really compare both is going to be much better than limiting yourself to EBITDA. But I think where the EBITDA comes in is it's simple, it's
Yep.
easy, it's a good place to start. We hear this all the time. Hey, I'd like to sell my MSP in 5 years. Okay, then what's your gross profit? What's your net profit? What's your EBITDA look like? And start from there. When you talk about those qualifiers that are helping you get a half notch or a full notch up on the multiplier, what stands out as most important from your perspective that you see?
Yeah, organizations that have a sales engine already built. If
Yeah.
you have a
Okay.
sales team that you've actually have a proven track record of getting out and getting new logos, that you can
Mhm.
show that year-over-year growth rate as a basically here's what my sales team has been able to do, and it's not owner-led sales, it's like a legitimate
Yes.
team. You've got, your sales manager, maybe two or three people on that dedicated team, and it's not based on your referral network as the owner. That sells for a half turn higher, if not a full turn higher multiple than any
Yeah.
other type of business that we see. I mean, that's probably the biggest driver. I mean, another one would be just overall like operational maturity when it comes to specific verticalization or the state of their contracts. So like if
Yeah.
you have
Yeah.
really good recurring revenue, like 80% or higher recurring revenue across your organization, which is like kind of absurd. That would be like basically the top 1% of companies out there. But
Yeah.
even 75 to 80% recurring revenue, you're getting a half turn to a full turn, potentially higher. And then that verticalization, if you're like highly specialized in dental or law or
Yeah.
name whatever area of verticalization you're in, that can also get maybe a half turn or full turn higher. But I want to caveat that to say that higher multiple is determined on you finding the right buyer that actually places that amount of additional
Yep.
value on
Yep.
you having that thing. So it's not even when we're doing valuations today, we're not essentially assuming you're going to get that half turn or full turn higher just because you have it. You have to find the buyer that's willing to pay extra for that because it's a buyer that maybe doesn't have the sales engine. It's the buyer
Yeah.
that is highly verticalized in dental or whatever. Or it's the buyer that really wants 80% recurring revenue because they want to try and help offset maybe the project-based company they bought a year ago. So you have
Yeah.
there's more to it than just you do this, you get X.
Yeah, I think you hit a really key point there around owner-led sales. You know, when I talked to Robert Gillette a few weeks ago on MSPs and how to be a differentiator in your sales, and I think it's if you don't have that process, and I think so many times they think about, well, I'm selling my business. It's like, well, yeah, you're also not going with that business. So yes, you might have grown 10, 20% historically, but if it's all one source, meaning owner led, people buy because they like Greg or Casey, but not the value of the business or the process. That's going to hurt against you the same way that, oh, I have agreements with them. I have some handshakes, or we have some old 12-year-old, 10-year-old, 8-year-old agreements that we haven't really updated. That's also a risk on the buyer side. So, like, what I need to calculate now, are we going to lose those clients? Are we going to be able
Yeah.
to grow without the owner a part of this business? And I think you made a key point. We see this a lot. And yeah, 80% of your revenue for managed service, that'd be incredible. But even if you're at that 60, 65% average, I think it's also knowing the financial ratios. What percentage of your MRR, your recurring revenue, is covering fixed costs and the
Yeah.
costs of the business? If you're able to cover 100, 110, 120%, you're going to increase, I would assume, that value because it's like, well, we don't have to rely on projects. We don't have to rely on subscriptions or software. So if there's anything we want to change from that component, we know the core of the assets, which is that customer base, is going to be profitable and valuable for the foreseeable future. Within a year or 3 years, we can improve and we can make an add on to this.
Yep. And I just want to add, you brought up a really good point with the like owner dependency from owner-led sales. I will say,
Mhm.
when we're talking about what are those things that give you a half turn to a full turn higher multiple, on
Yeah.
the inverse, the things that give you maybe a half turn to a full turn lower multiple are
Yeah.
those owner dependencies to the extent that the business only can function with the owner
Yeah.
in wearing the 4 different hats that they're wearing. Huge risk factor to a buyer, and they will greatly reduce the value of the business if that is the case. The second biggest one is customer concentration. If you have a
Yeah.
really huge, like greater than 25, 30% customer concentration in any one customer,
Yeah.
massive decline in value, and or at the very least there's some sort of contingency placed on the deal that essentially you now have to make sure that not only that client stays, but they potentially grow in order for the buyer to be willing to pay the price that they're paying for your business because it's such a big risk factor. So at the end of the day, if you mitigate those two things, which you for the most part you have control over doing, by growing your other customers and growing new logos, and then getting yourself out of wearing 4 different hats, you can now de-risk your business. And so a lot of what we coach companies on is how do you de-risk as
Yeah.
well as create, incentivizing or really attractive components of your business, but it really is a risk game and from risk mitigation in order to get a higher multiple.
Yeah, I think there's two parts to that, and I really that's great insight. And I think one of the big components is this isn't this shouldn't be new. This is operational maturity at its most basic level. Like you, as an owner, you should want to be able to gravitate outside of sales and being the only sales force. The same way that when we talk about financial maturity on our end, once the accounting's done, once you have core books and things are being done, your taxes are done, everything's accurate, you should be using finance not just as, oh, we're paying bills. No, to lead decision making, to build a plan, to improve valuation. It's no different in the other areas, operations, sales, HR, marketing, all of those other functions. And then to your point about that percentage of sales of a revenue or major clients, I remember sitting at ChannelCon last year. Cogent had a really good presentation, and one of the things they talked about is your top 5 customers should not be more than 20% of your total revenue, and that's like a good place to start, because I think there's a lot of MSPs where, whether they've been in business for 5, 10, 20 years, they have that one or those 2 or 3 clients that help them get started. Maybe, oh, I used to work for them at the bigger guys. I went and started my own thing. They've been with me since the start. Understanding that you need to have process in place with those, but then also you can't live off legacy. You have to be able to make
Totally.
those while the revenue is great. Even if you're not looking to sell, you should mitigate that risk by saying, what if they went out of business? What if that company was acquired and now they have their own internal IT team? They no longer need me. Those are the reasons, in addition to why it improves your valuation, but also why, as a business owner, this should be important. It's mitigating risk in your business, and your greatest asset. And we always say, typically your greatest asset as a business owner is your business. It's not your real estate. It's not all the other little projects you do. It is that company. So giving it that holistic approach across all areas is usually beneficial when it comes to not only improving valuation, but just building a better business as a whole.
Well, yeah, and I was going to also add that it also proves the value of the business, because now your value
Yes.
isn't on one customer and their
Yeah.
success and how they're growing, and they're needing 800,000 or $1 million of service fees when they could
Yeah.
potentially even bring it in house because they're spending so much with you. It's like, no,
Yeah.
your success is actually fully dependent on what you're doing as a company,
Yeah.
and not dependent on your clients growing for you.
I feel like so many people talk, when you talk about M&A and valuation, all that, they always talk about the bad things. What are some of the good things, the good trends that you see right now in the MSP space that it's like, wow, I'm surprised MSPs are doing this really well?
I would say buyers are just overall getting more educated and smarter with the
That's good.
process, in terms of like, when they're coming to the table, they're not just throwing numbers around. They're really just trying to get right down to it to try and get to the LOI. We're seeing less and less IOIs, more and more like, here, let's actually sit down, let's get to know each other, let's build a relationship, and let's put forward a meaningful LOI. And really, like, even though an LOI by definition is not legally binding, we're going to
Yeah.
actually operate in good faith, assuming that it is legally binding. And we want to work as a partner with you throughout the due diligence process, not adversarial to you. And so we've really seen that with a lot of the buy
Mhm.
side partners that we've done transactions with over the last
That's good.
24 months, where you would think equality of earnings would be the point in time where it's hand-to-hand combat, and they're basically, going head to head against each other with our sellers that
Yeah.
we're representing. But really, we're actually seeing a lot of kind of cooperation, teamwork, trying to work together to get to the greater, destination, which is, we are stronger together than we are apart. And I think
Yeah.
that type of mindset is really powerful when you throw it into acquisitions and like mergers and acquisitions, because I think the MSP, like most of the owners I've met in the MSP kind of space, very much have this kind of cooperative friend, let's help each other
Yeah.
out, pay it forward type of mindset. And I think, you guys at Stride, and we at iTValuations have that same mindset. We want to just pay it forward. We want to just give this information out to people, because we really want to like build a community that really looks out for one another.
Mhm.
And I think it's spilling over even into those private equity backed
That's
MSPs,
good.
where private equity that came into the space initially brought that same private equity mindset that maybe you've heard horror stories about, but it's now
Yeah.
shifted, and it really seems like it's more of a friendly, like, and not to say that you're going to agree on everything, but I'm just saying that it's
No.
it's a lot less adversarial than maybe it used to be.
Yeah, I definitely share that sentiment. I think it's why I love the MSP space, because obviously we serve other industries at Stride, but I think MSPs is the one where it's incredibly collaborative, it's incredibly proactive, it's partnership oriented. It's hard. I've been there. I was a growth manager at MSP. I've sold those services. I know what it's like. It's not easy. So it's a lot easier when you have partners and people in the industry you can bounce off and build a better business, because you're being responsible for a lot. We see this at Stride because we don't just tackle one area like tax or account. Like, we're doing everything around accounting, finance, tax, strategy, even operational improvement. So finding partners that are able to do that. So I'm glad to hear that. Now, on the seller side, what are some of the things you're seeing that the companies who are, the million, the two, the $5 million MSPs want to sell? What are you seeing that they're doing well on their end?
Yeah, I mean, I think what we're seeing is a lot of companies have started to actually think about selling long before
Yeah.
they actually are needing to sell. And so what we were noticing maybe, 3, 4 years ago, like, immediately right after COVID, is all of a sudden
Mhm.
people are like, I need to get out. I need to pull
Yeah.
the
Yeah.
parachute, pull the ripcord, I need to sell. And then all of a sudden now you're making a hasty decision with your most valuable asset. And that
Yeah.
potentially warrants or renders a lower number than maybe you ultimately could have gotten had you actually done the right process. And that's really why we, with our valuations, like launched our valuation as a service program to really be more of an ongoing valuation process for
Yeah.
companies to try and basically lead them up until that point of potentially exiting, because every owner is going to exit their business in one way, shape, or form, you
Yeah.
know?
Yeah.
And so it's a matter of how do you want to exit? Do you want to exit on your own terms at your own number that you ultimately want to
Mhm.
achieve? Or are you going to basically be forced out of your hands, you're going to be tied and you kind of have to get out? And so
Yeah.
that's where I think sellers are doing a much better job of, okay, if I can fix these one or two things, I'm going to fix them now rather than just settle for selling because I feel like I have to. And I think that's just
Absolutely.
also the sweet spot that a lot of sellers find themselves in there. Most of the companies we talk to are in their 50s, maybe early 60s. You know, everyone seems to be like 2 to 3 years away from a transaction, which basically means if
Yeah.
the right number came today, they'd sell, but they're really like they're just preparing their business. And so they're doing a much better job of preparation for that day.
Yeah, we see that. I share that same sentiment. It's funny when I first was at Stride, a couple of years ago. It was always, I'd like to sell in the next year or 2 years, and now it's gravitated towards next 3 to 5. Well, maybe 5 to 8, and I really want to improve. And I think a lot of that comes from they weren't getting what they wanted. They were seeing, oh, I'm not as valuable as I thought, and time. That
Yeah.
education and time of, oh, if I implement this, I can do a much better job. And a lot of the times we see them, you know what, I was thinking about selling, but now I've just built a solid lifestyle business, and now I have the option. I'm prepared. The same
Right.
way that you have a will, or on the accounting side, we're always preaching, do you have an accountable plan? Is there something like if something happens, do you have that in place? Because whether you believe it or not, everybody's going to exit eventually, one way, shape, or form, depending how
Yeah.
the Lord see fit. But there is one way that you can guarantee, yeah, I can be in better shape if I prepare. But a lot of the times, if you're in disaster mode, if the books are wrong, or you can't get clarity in your process, or your operations seem to always be on fire because those 5 clients just constantly bring you issues every month,
Yeah.
start there first and then gravitate. I do want to talk a little bit because I think what you guys do is really impressive, but I think most don't understand what is valuation as a service. How does IT valuations, and this isn't a sales pitch, this is truly a why should I be thinking of valuation as a service regardless of how I go about it? What is the value to me as a business owner, and how does that work?
Yeah, really what we were noticing is every valuation we've ever given in our history, we're leaving business owners with more than just the number. We're leaving them with like, hey, if you did X, Y, and Z, you could actually see a certain amount of increase in your value. So we want to try and guide and really give actionable objectives and improvement ideas to here's
Mhm.
what you could do to make your business more valuable. And what we were finding is a lot of companies would get an annual valuation with us or once every 2 years. And the same things that we advised them on the previous year are the same things that were still broken a year later or 2 years later. And so we're like, well, how can we have more regular touch points, more regular accountability, more regular review of these items to actually ensure that the value is trending in the direction we want it to and that there's actionable steps being taken against those recommendations. And that's where we
Yeah.
launched this valuation as a service, where it's more of a business transformation, like coaching type of service and platform, where we're not only just doing the value of your business, we're giving you those actionable steps. And now we're going to walk with you each quarter to see, okay, how is it going? Are you actually making those changes? And if you are, what is now that ROI that we're actually seeing from a value perspective? And even if you haven't now had 12 months of runway to show that full year's worth of financial statements with that improvement, we can now project out, this is what trajectory you're
Yeah.
on because of the 3 months of improvements you've made, and start to paint that picture of it, you could now sell for X because you did this.
Yeah, I think that's incredibly beneficial because visual learners in this space, they want to
Yeah.
see and then they want to see the results. They want the data and feedback. And I think being able to do that to say, hey, you've done this and this is what it's done for you. Now, I
Yep.
know it's a combination of software and process, correct? It's a little
Yep.
bit of showing them, okay, what are some of the key drivers that you're pulling from a financial perspective? Like what matters? Is it the margin percentage? Is it profit? Is it top line revenue? What are some of the top 3 or 4 metrics that really matter from a financial perspective?
Yeah, so what we look at is, when we're looking at your financial statements, we're looking at your growth rate, we're looking at your gross margin, we're looking at EBITDA. So if I look at literally your growth rate, gross margin, and EBITDA, I can basically write you a little bit of a story of what I believe your business is doing well and what I believe maybe your business is maybe doing poorly. And because the financial statements truly tell a story. And
Yeah.
if you
Yeah.
want the financial statements to tell a different story, or you want your story to be different to a potential buyer or someone else in the future, well, then you need to change your fact pattern, which means you have to change the inputs to your financial statements. And so what we then look at is, okay, general rule of thumb. General rule of thumb, gross margin, in order to hit that best-in-class EBITDA metrics of 20% or more, you have to have gross margin of 20 or 45% or more, right? So in gross margin, you have to make sure you have all of your direct labor, fully loaded costs in your
Yes.
COGS, so that when you're doing your pricing on top line, you're actually getting to the right gross margin number, which is then hopefully setting you up to truly hit that high EBITDA target. You know, on
Yeah.
average, we see companies spend between 20 and 30% of revenue on their operating expenses or overhead expenses. So that's like sales, admin, rent, you name
Yeah.
it, any of those operating overhead expenses. So if all of a sudden you're spending more than 30%, well, then that should be dialed back. But that's usually not the case. And so I think when people think about
Yeah.
increasing profitability, they think about cost cutting. And really, it's more efficiency, productivity, and price structuring optimization versus cost cutting. So that's a lot of what we do and what we're looking at, because I think just a couple of those simple tweaks make your financial picture so much drastically different and obviously the value as well.
Yeah, I agree with you. It's rarely the SG&A, it's rarely the overhead. That's not where it is. I think it's the misallocation. We see a lot of companies that one aren't allocating really their true payroll. Not all of your payroll is COGS, but a lot of your payroll, most of it should be COGS. And I
Yep.
think secondary is a lot of MSPs they'll have that artificial gross margin. Oh, I'm 65%, but none of the allocation of labor. They're not allocating certain tech and tools, and they're also not allocating certain procurement that goes in there where it's like that's a huge component, and you wonder why, my gross margin 65, my EBITDA is 2%, my profits 1%, 3%, 5%. Well,
Right.
why is that? Well, it's probably because you're either overstaffed, which I get it. I hear so many MSPs, it's hard to get talent. So when I have that downage of I don't have as many clients, or I have a couple client losses, I don't want to lose this guy or that gal because they're so great. Fine, I understand that, but you need to calculate that as a part of gross margin so you can see that fluctuation in the true revenue production profitability every single month. And it allows you to say, do I need to do one of two things? Do I need to improve the profitability of my revenue? Or do I need to invest in sales or growth so I can add more of that top line? It really gives you that clarity to say, this isn't a hiring staffing problem. This is, I came up with 150, 175 per seat. Maybe I need to be more. Maybe I don't truly know what it costs. Because if you just pulled your pricing out, because I talked to Robert Gillette about this a couple weeks ago, you saw 3 other competitors in your area and you picked the middle rate, probably not going to be a long term, and you're probably missing out on revenue that's valuable to you. And
Right.
then also misunderstanding what differentiates your MSP from those other 3 that you're competing against, or other 5 or 10 or 20 in your market. So I
Yep.
think you really hit the nail on the head there with gross margin, and then what it looks like to build that profitability that's sustainable. Because if you're really truly at a 50% gross margin on your revenue, and that's true gross margin,
Yeah.
meaning your payroll, everything's in there of your cost of goods sold, you're doing pretty well. You can find the rest and you can make that math equation and say, hey, EBITDA can be 20, 22, 24% as long as you keep the rest of the overhead in check.
Yep. 100%.
Now, on your end, when you talk about the implications of, because we deal with this all the time too, prior year messes. And what I'm talking about is the tax scrutiny. I know you see it when balances aren't right, retained earnings aren't right. Maybe you're not the right structure as a firm. Maybe you're an S Corp and you should be a C Corp, or you're an LLC or a partnership and should be an S Corp. How do you approach those conversations, or how are you approaching to say, hey, I know we're talking about valuations and the excitement of selling and the asset of your business and playing the numbers game, but we got to go back and there's some investment on the tax side. What do you see in terms of the trend, and how often is that really a core issue where, hey, you're going to have some sort of tax cleanup to get to this next point?
Yeah, we see it quite often. I mean,
Yeah.
specifically where it's like it's just more missed opportunities where maybe there was something done
Okay.
incorrectly, or because now the accounting was messy. If you actually cleaned it up, it's actually amounting to a net greater deduction, from
Yeah.
and therefore a refund. Where it's like, hey, let's actually focus on getting those things cleaned up. Let's get those refunds, get that cash in the door, because cash is king. And then once that's cleaned up, now it's also do a separate assessment of, okay, what is the right structure for you?
Yeah.
Because, if you have a desire to sell someday, well, generally in the marketplace right now, most MSPs are S corps. When an S
Yeah.
corp goes to sell, by definition, they go through what's called an F reorg. And the F reorg, all it does, it takes your operating S corp and creates a new holding company above it. And then you sell the units or the shares of that operating S corp that's now an LLC to the prospective buyer. And now the buyer, whether they're a C corp, partnership, or S corp, can now own 100% of the stock of that operating S corp. And then you can tax it as an asset sale under section 338H10. So effectively, it's a stock
Yeah.
sale that gets taxed as an asset sale. Now, why does that matter for an owner? Well, it's
Yes.
okay to be an S corp when you go to sell, because this is going to just happen as part of the paperwork when you sell. Because I've heard some people say like, oh, you can't be an S corp if you're thinking about selling. And the answer is you can. But if, say, you were going to try and buy other MSPs before you sell, or maybe you want to try and give equity to your management team or other people within your organization before you
Yeah.
sell, there might be a better structure for you when you look at a partnership or you look at a C corp that renders a better outcome and a better ability to give that equity either tax-free or minimize the tax impact, or at least minimize how much of your value you're giving up to those individuals to bring them on, than if you do it in an S corp, because everything has to be pro rata in the S corp. And so that's a lot of what we try to say is identify what you want your long-term objectives to be, and then pick the right structure and the right plan that meets those objectives.
Yeah. I think that's key. And obviously, like they usually say, stock sales are better for the sellers, asset sales are better for the buyer, typically based on the percentage of where you're getting taxed, the capital gains versus post-tax. So I think it's, don't limit yourself because you're thinking, oh, what's my structure? What's it? It can all get taken care of later. What really, the things that are important are making sure the foundation of financials true and accurate, the growth rate. It can't just be, oh, I have a profitable business, but are you growing? Are you continuing? Because some buyers, I've heard it, buyers are like, hey, I don't care if you're growing. We just need exposure in this market. Maybe we have Charlotte and Atlanta and we need something in between. Or, I'm in Cleveland and Toledo and I want to get Indianapolis. But if you're truly looking for the max, make sure you have that growth rate, and then fiscal responsibility, meaning not just, hey, I'm closing my books, but how profitable are your top clients? How much of those top clients are your total revenue? Is your revenue profitable? Do you really know your COGS? What am I missing? What haven't I asked that you'd really say, you know what, Casey, if you knew this, you'd ask this. Greg, from your perspective, what do I need to ask here?
One other thing I would say on growth rate, so many people look at growth rate and assume that's new logos and new business. Growth
Mm,
rate is also existing customer
yes.
growth. So
Yeah.
cross-selling, upselling, revisiting those contracts, the pricing on them, the services that you're rendering on them, that is just as important as going out and getting new logos. And so I just see too many companies that put that 15-20% goal in mind for revenue growth and say that's
Yeah.
their
Yeah.
goal for the sales team. But really, that needs to be your net revenue growth, net of customer attrition, that where they leave the organization.
Yeah.
But it's also the net of any existing customer growth as well. So if you get 10 to 15% existing customer growth, which is possible when you think about price increases, cross-sell,
Yes.
upsell, your customers growing, if you have a per seat license count, if you're getting 10 to 15% and then maybe you lose 5% for attrition because of mergers and
Yeah.
acquisitions within your customer base, you're still at maybe a net 10%. And that means now your sales team only has to hit 5 to 10% new
Yep.
logos. That's maybe 2 to 3 accounts. And now you make the math a lot easier to actually go out and hit your goals and objectives. So I think
Mhm.
that's a way that you can demystify that 15 to 20% growth rate and actually make it attainable for your management team and your sales team.
Yeah, I think that's a big component because I'm a firm believer that an organization that focuses on sales sells more, meaning organizational sales matter. It's not just for the sales and biz dev team, your account managers, your owners, your leaders, your VPs, having that opportunity and abundance mindset to be like, no, I'm not selling something new, because we face this. Accountants don't like to sell, but they like the solution. so do your technicians, so do your managers, because they're going to say, you need this service because I've identified a problem. Yes, there is a purchase and there is an investment into that. But if you see it and flip the script to say, I'm not just trying to sell more and upsell my clients, I'm trying to solution. I'm trying to make their lives better. So that way we're differentiated when they say, I'm looking at my costs and my expenses. Do I keep this MSP or not? Yeah, of course I do, because they're not just a managed service provider. They're truly a solutions partner. And I think it also takes that pressure off your sales team, because new logo growth is hard. I'm not going to, sugarcoat it. It's hard to add new logos, especially as an MSP. So if you can incentivize by helping that be really truly a team effort, so you don't just feel like, I got my salespeople out there on the, the frontier and they're doing their thing. What do you got this month? It's like, well, you guys have something, or we have support. I think that's a big component too. Growth rate really does matter, but it's not just adding new customers. It's also continuously improving the new base you have. We're getting close to time here. I try to keep this, around a half hour, 25 minutes to a half hour. What's the too long, didn't watch, 60-second, Greg, that would say, if you listen to nothing else from today, but listen to these 60 seconds, an MSP owner would have value from it? What is it?
If you're an MSP owner listening to this and you want to even just begin to understand the value of your business, look at that revenue growth, look at that gross margin, look at that profitability, look at your gross margin. How close am I to 45% when I get a fully loaded gross margin? When I look at my overhead expenses, is it between that 20 to 30% of revenue, general range, general rule of thumb? Now, if you have a goal of hitting 15 to 20% EBITDA and you're not there yet, what is your plan to get there? Do you have an actionable plan in place? And how are you actually holding your management team, sales team, or other people in the organization accountable to it? And if you don't have a management or sales team around you to help support you as a business owner, how can you step into that next evolution of your business where it's not just you and a bunch of technicians, it's you with a team around you to help you scale from the 1, 2 million to the 3, 4 to the 5, 6 and beyond? Because 1 million, 3 million, and 5 million, and then 10 million are the biggest hurdles we see for businesses. So depending on where you are, identify that hurdle and identify what you need to do to blow through that ceiling so that you can now step into the next evolution of your business.
Absolutely. Greg, I really appreciate taking the time. Once again, you guys can visit iTValuations at iTValuations.com. I'm sure we'll have you on again, because this is a lot and a meaty topic that we could talk all day about. But once again, thank you for today. I appreciate your time.
Awesome. Thanks, Casey. Thanks for having me.
Thank you. All right. That's great.